Taxes can be a huge drag on your retirement income and your retirement success. What are 3 ways that you can cut your taxes in retirement? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There's 6 areas to your financial life, my financial life, everyone's financial life. And the big idea is those different areas aren't to be sort of separate and distinct parts of your finances. In fact, they overlap with the others. And here's a very clear example. And if you are planning for your taxes, tax planning is different than tax preparation. Planning is proactively looking at opportunities to improve your tax picture. If you're doing that, then you're looking at, well, what things can I do to reduce my tax bill today or my tax bill out there in the future? But that's obviously connected with your cash flow and with your retirement plan. Because if you aren't planning ahead for your taxes in retirement, and all of a sudden when you get to your retirement, your taxes, the taxes that you're paying are a significant amount, then that's going to create a drag on your retirement plan. And it's going to mean that your retirement dollars, your retirement nest egg, doesn't last as long as you need it to. And it's going to be a drag on the income that you need because, and many people do this, by the way, if they're not taking a comprehensive approach, is they look and they say, well, right now, my take-home pay while I'm working is, say, it's $6,000. And when I get to retirement, my Social Security will be a couple grand, and I'll take another few grand out of my retirement and see it'll all work. Well, they ignore the taxes, right? They ignore the taxes. And without tax planning, it can really torpedo your retirement plan. So what are some things that you can do to cut the taxes that you're going to pay in retirement? Before I get into the 3 ideas, I just want to impress upon you that financial planning, comprehensive financial planning throughout your career to create tax diversification and to be mindful of the taxes that you're going to have to pay in retirement can really set you up for a lot of different choices. And so if you, depending on where you're at right now, if retirement is still a few years out for you, do the tax planning work with your CFP today so that you show up at retirement's doorstep with options, and that way you can reduce the amount of taxes that you pay. All right, let's get into it. The first idea to limit and reduce the taxes that you'll pay in retirement is to limit the amount of tax that you're going to pay on your Social Security. That's right. No matter what your financial situation is and plan for retirement, Social Security is going to be a bedrock, a foundation to your retirement income. And most people think Social Security is not taxed. And I would say that's logical because the money that you paid into the system, you paid with after-tax dollars. And so, of course, when they give you the money back, they're not going to tax it. Wrong. A couple decades ago, they introduced that they're going to start taxing Social Security. And then a decade after that, they added another tier on that calculation. And then it hasn't been updated since. And by the way, these numbers haven't adjusted for inflation either. Take a look here. If all of your other income sources plus half of your Social Security, if that exceeds $32,000 as a married couple, married filing jointly, then some of your Social Security starts landing on your tax return as taxable, up to 50% within that threshold. And if that all of your other income plus half your Social Security exceeds 44%, then more and more of your Social Security starts coming onto your tax return up to till 85% of your Social Security lands on your return. Now, the tax isn't 85%, but it's the amount of your income, your Social Security income, that is taxable is 85%. So 85 cents of every dollar of Social Security would become taxable to you. And you can see that's a very, very small runway. That if you're not paying attention to it, then all of a sudden you can go from, no, my Social Security is not taxable, to 85% of my Social Security is taxable. It's a very big swing with just a few dollars. So being aware of this calculation and being aware of, well, where should I draw income from? Should I draw it out of my Roth? Should I draw it out of cash in the bank? During my career, should I do Roth conversions? Should I do more contributions to Roth and HSA so that as I draw those dollars out, it's not going to influence this formula? Being aware of this formula and doing proactive planning work so that less of your Social Security is taxable ultimately is going to save you significant amount of tax on your income in retirement. Second strategy to cut your taxes in retirement, we do this one all the time, and that is doing laddered Roth conversions early in retirement. Laddered Roth conversions early in retirement. And you might say, well, wait a second, a Roth conversion is moving money from pre-tax IRA, pre-tax 401k that I've never paid tax on, and shifting it, moving it over to the Roth, and so that it's in the Roth and growing tax-free forever. And that maneuver is taxable. Any pre-tax dollars that are in your IRA or your 401k, as you shift those over to the Roth, you pay tax on those. And you might say, well, wait a second, that's not cutting my taxes in retirement. I'm actually paying a lot of taxes in the year that I do these conversions. I know. So the idea is do a few laddered early on in retirement, maybe a couple years at a time, 3 years at a time, so that then you have more of your wealth positioned in the Roth IRA to grow tax-free for you in the future. By the way, that also helps you with the first idea, because as you pull dollars out of the Roth out there in the future, it doesn't count as income towards that formula for taxing your Social Security. So whether you are retiring in your early 60s, and maybe you delay Social Security a little bit, and you do a couple years of Roth conversions, throwing $100,000 or $150,000 from your IRA over to the Roth IRA, that can help you accelerate this very quickly. And then because you do that early in retirement, not impacting your IRMA, not impacting Medicare, but you've got those dollars positioned in your Roth for the next 1, 2, or 3 decades of retirement, so that all those dollars are growing tax-free. And then a third way to cut taxes in retirement is one of our favorite tax planning strategies. We've talked about it a lot, and that is the qualified charitable distribution. Of all the tax planning ideas, this one seems like it's the most underutilized. Why? Because it doesn't start until you turn age 70 and a half. Also, it relates to how you make charitable contributions or charitable donations. And so by the time you're age 70 and a half, you're pretty set in your ways. I donate to the church in this way. Every Sunday, I'm putting money in the offering, or every Sunday I'm automatically making a donation online, or maybe you're making a donation to some causes you care about at the end of the year, and you do that out of cash or out of cash flow. Well, once you turn age 70 and a half, if you do that directly out of your IRA, where instead of the money coming to you and then going into the offering, it goes directly to the charity, directly to the church, that money doesn't show up as taxable on your tax return. Therefore, you don't need to report the income and then hope you get a charitable deduction, which many people aren't these days because of the standard deduction and how high it is. This allows that income just to not be taxed. And therefore, you're saving tax on those dollars. By the way, it's also helping you with that equation and issue number one, which is taxing your Social Security. So qualified charitable distributions after age 70 and a half, another great way to cut your taxes in retirement. Those are just 3 strategies that you can consider with your certified financial planner to cut your taxes in retirement. Again, what's at stake here is the less you're paying in taxes, the less you're paying to Uncle Sam, the longer your hard-earned dollars, your nest egg, can work for you and help you avoid inflation risk or battle inflation risk and battle longevity risk and the risk of you running out of money later in retirement. So big deal. Reducing the amount of taxes you pay in retirement, it requires a comprehensive approach looking at all 6 areas of your financial life. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.